PowerPoint presentation. So to be able to communicate with us here at PAMIC, at the PAMIC studios in Wormleysburg, PA, you can connect to the audio portion of this presentation either through your phone by dialing the number that you see there and putting the access code. And for you folks that have a little bit more experience using your computers, you can actually call in via the internet. And both of those procedures are listed right there on slide 2. The other thing I want to point out is we are doing a little shameless self-promotion here at PAMIC by putting some save the dates in for future educational opportunities, and you'll get to see that on every slide of this presentation. The other thing is that even though you're not able to talk to us directly through your phone, and we do that simply to keep the background noise down for everybody that's participating. You can communicate with us through the chat feature. At the top of your screen, you will see a green chat bubble. It kind of looks like one of those bubbles you see above cartoon characters. If you click on that, you'll then see all the names of the people that are registered for this class. In particular, I want to point out that any questions you have, you just choose the VIS, Virtual Insurance School questions, and send them in, and we'll try to respond to them during the course of this presentation. If you're having technical difficulties, you use the chat feature as well, and that will go to our technical person, Vaughn Lawrence, who's sitting right next to me. So with that, I just went over the technical support already, so you see how to do that. And you can also email Vaughn at his email address, vaughnvlawrence@pamic.org. So with that, my introduction is over, and I want to turn it over to Jack Janoski. Jack, I thank you for taking time out of your schedule to be with us and to help direct this program for the next hour or so.
Thanks, Ron. Good afternoon, all. We're going to touch on a few things to start here. But one thing I want to bring up, this week, a friend of mine, a good friend of mine in Kansas, passed away. Most of you probably never heard of him, but he was a deputy commissioner at the Kansas Department. And he worked on the producer licensing working group where Ron, when he was deputy commissioner for the Commonwealth, had me outlined there when I was running licensing for him. And Leroy Brungart headed the education development, which presently for producers, we established the uniformity standards, the CE reciprocity form, and that was Leroy's baby. He developed that, which all the CE providers now use across the country to file their courses in foreign states for reciprocity approval. He was quite a mark on the education field, and he was a great support to me in my learning days in the Lion's Den when Deputy Commissioner Gallagher threw me in there like a little lamb, sort of like he sold me a bill of goods. But back to this. This outline is, like Ron said, is designed to bring some basic background knowledge to folks just coming into the business or new in a position. And it does touch in several areas. I found it very interesting in some of them. Some of them seem to go in a little more detail, which if you followed through the course and you've completed it, you would have seen that there were little icons that you could click and get a more substantive explanation to what was on the screen, especially in the areas of combined ratio and operating expenses and things of that nature. That's probably a little more detail than most of us need today, but you have the gee whiz information there, and you can benefit from it. You may understand how when companies are looking for premium increases and things when they're talking combined ratios and underwriting loss, what they actually mean. So to start out, we'll start with the very first one, the outline. It shows the benefits of insurance. And the two key areas in this section are actually A and B. What is the primary role of insurance? And regardless of the line of business, whether it's P&C, life and health, the primary role is indemnification of a claimant. And indemnification actually means to bring the claimant back to pre-loss standards. Okay, the concept is that they are not to benefit from it. Now, I know that some folks maybe in the claims areas are sitting there saying, well, if they have replacement costs on their contents or replacement costs on their home, they're getting something new where they had something old. But you're actually indemnifying them. You're giving them back their property. So it's an elective to have that type of coverage. But like I said, regardless of whether it's life, health, auto, or home, indemnification is the primary role that insurance plays. It indemnifies people for covered losses under the policy. Okay. Then you look at the other areas there, reducing the financial uncertainty. That's all done through the claims management and the underwriting process. Those are the roles that those key people play. The marketing arm is dealing directly. The control arms are in the back. And then you go further down there, you see where it shows you like satisfying legal requirements. Now, in this one, I thought it was kind of neat. When I opened the screen, it had various things on it. So I made a couple footnotes that one, your legal requirement, a good example of that is your motor vehicle financial responsibility law in Pennsylvania. If you register a motor vehicle for highway use, you satisfy the legal requirement through insurance. That is not the only way to satisfy it. If you actually look at the MVFRL, you can self-insure, you can purchase it through insurance, or you can use some other form of risk retention that you have to post with the Department of Transportation. And there is a little bit of confusion sometimes. There are many folks out there that think the MVFRL that requires you to obtain financial responsibility to operate a vehicle is an insurance law, and it's not. It's in Title 75 motor vehicles. The only thing in the insurance laws is the termination of the contract, where if they're going to non-renew, what has to be there. If you're going to midterm cancel, what has to be there. But the fact to have it is in the motor vehicle code. But that satisfies a legal requirement. A financial requirement would be something where you buy the homeowner's insurance because you have a mortgage, and by giving a copy of the deck sheet to the mortgage holder, you satisfy the financial obligation of meeting the burden that protects their collateral, your home. So those are some of the reasons that you buy insurance. But the reason that you have the insurance is for indemnification. Don't know if there's any questions coming in on that. None yet.
If you don't mind, Jack, I'd like to add a little color commentary here. Deputy Commissioner Steve Johnson spoke about a year or so ago, and if anybody knows of him, he's a very passionate man when he speaks about insurance. And he's actually retiring at the end of this month after spending 35 years with the state government. But what he says is that insurance is the engine that drives our economy. Without insurance, businesses can't operate. Homes can't be purchased, bought, and sold. Cars can't be driven. So the role that an insurer has is critical to supporting the economic vitality of our communities. And you guys, as mutual insurance companies located, many of you located in rural areas, do just that. And in fact, we're formed with that purpose in mind, to deal with issues, whether it was lack of insurers in a local area or kinds of coverages that didn't exist with other insurers. But we play a very important role as insurers in making sure that our economy thrives.
Okay. Well, that's a great segue to the next one, the functional view of insurance and the core functions. And of course, as you see in there, there's three core functions: marketing and distribution, underwriting, and claims. Now, as Ron told you in a brief info, most of my experience goes to marketing and compliance, market control. Underwriting, I do have some experience in it, but I didn't make a career out of it. But we'll deal with each one separately. In the marketing, the primary marketing in Pennsylvania, as it is across the country, is done through the Pennsylvania insurance producers, but we'll just call them agents. Agents and agencies are the primary marketing tool. And with those folks out in the field, they promote your product. They are supposed to adhere to your guidelines as the insurer as to what you want them to do. Many companies set benchmarks for production. They expect this much production. They expect, certain levels of loss, and that the marketing by an agent is actually field underwriting. So you should, as an insurer, be expecting the agent to act in your best interest in the field. And typically, when an agent enters a contract with an insurer, he agrees to represent the insurer in accordance with the terms, and he is the representative of the insurer. So they should have the insurer's best financial interests at heart when they're out there. So to use a term, they shouldn't be dumping business just because there's no place else to place it with an insurer. They should be doing their job. And all of the costs that go with that marketing usually fall to the insurer because they reimburse the producer commission-wise for the sales, but that only makes up a small portion of issuing the policy, doing the underwriting, and that's a key function. The underwriting in the market, the underwriter pulls reports, credit reports, loss history reports, as much demographic data on the proposed insured that the underwriter can obtain, that the underwriter can make an informed choice. That is the key to underwriting. They assess the risk of loss, and if the risk is acceptable to the standards of the insurer. That's a key function, and it's a very important function, because when that function does not go correctly, none of the other functions are going to work correctly. The underwriter plays a key role because they bring the risk in. They bring in the premium dollars. So they have to be very astute in the information they're looking at. And under laws of Pennsylvania, most cases, they have 60 days to do that job and do it correctly. After 60 days, the underwriting data is sort of moot to termination of the policy. There has to be another reason. So in that 60 days, they're trying to gather that information. Now, it sounds like kind of simple. Yeah, you're working on this for 60 days, but you have to remember the amount of business that's going into that underwriter. They're not working on one case at one point in time. So they screen that out. And of course, once they issue the policy and the premium income is coming in, the premiums are there, then as I was told in 1975, very early in my career by a manager, the reason that we have claim forms is we expect claims. And that is true. He also told me that premium payers pay too much and claimants never receive enough. That's probably true too. When you deal with it from both sides of the fence as I've dealt with it. But in the claims area, now you have different types of losses. You have, when a loss is incurred and it's reported to the insurer, they set reserves. They set back an amount of money that they feel is going to cover that claim. Not necessarily all the time, okay? They may have a loss that they set reserves of $5,000 for. Maybe it's only $3,000, and that's what they pay out. That's adjusted at the end of the day then. And then it also can go the other way. They can set $5,000 and end up paying $8,000. The last thing an insurer wants to do is delay the claim and drag the claim out to where they're sued for bad faith. That's basically a legal action where the insurer was inactive, even though they had sufficient information to pay the claim. And under Pennsylvania Unfair Insurance Practices Act, the law in that section actually states that once the liability is clear, they should be paying the claim. Okay? So those are the three very key areas that drive an insurance company: marketing, underwriting, and claims.
Jack, I do have a question here for you.
Okay.
So you mentioned earlier that under marketing and distribution, the primary method for marketing is through the agent or agency force. How does the internet play a role in marketing and distribution?
Well, it's coming up. There are companies, especially in the personal auto market, that deal exclusively in the internet. You can get them on a phone, or you can do it through the internet. They really don't have what would be referred to common folks as an agency field force. But it is up and coming, and with the younger generation, and I'm talking probably people under 30, they probably will buy on the internet faster because of just their lifestyles. They're probably both working, very, very busy, and they would, rather than sitting down with an agent or going to an office, will buy online, and hopefully they can make the right choice, where people, say 40 and up, are less likely to buy on the internet. And then if you have people, with gray hair like me, they probably would refuse to buy it. And we had the same when we were doing licensing. When we wrote the new licensing law, we were driving towards the use of technology, and we found many times that agents under age 40 would renew online in a heartbeat, and agents were in there over 50, approaching 60, very hesitant, and those over 60 would actually carry the renewal into the office and leave it with licensing staff. So it's not that the internet is any safer or having an agent is any better. It's just one of the areas that you have younger folks tend to deal more on it. They probably pay their bills off their iPhone, and some folks they write checks for everything. So, that's just the way it goes. But the primary role yet is the agent, especially in the commercial market. Okay. Well, we'll roll on to revenue and expenses. And like I pointed out, there's some key slides in the presentation on revenue and expenses. But the primary revenue for an insurance company is its premium income. And I saw this and I chuckled when I saw it, but it's something that maybe many people do not understand, that there's earned premium and an unearned premium. And when you pay your insurance, typically homeowners is paid annually, and auto, it can be paid annually, but most people either pay it quarterly or semi-annually. When you pay that premium, so if your premium was due today and you pay it, the company really hasn't earned the next 5 months of premium. They provided no coverage at that point, okay? We're not talking about termination of the policies when you use short rate or pro-rate cancellation formulas. What we're talking about is earned premium. They've earned a premium, and they only earned the premium when they provided the coverage. So premiums paid in advance are unearned premiums, and unearned premiums are liabilities to the company. They owe the money back if they do not provide the coverage. So that's something you want to keep in mind as you might be looking at exams or going down to test questions. Unearned premiums are liabilities to the company, not revenue, not an asset. The other form of revenue that goes into a company is the investment income. And investments can be a headache to an insurance company at times. Everyone knows the markets fluctuate, but we in Pennsylvania have had some issues in the past, especially in the late 80s and early 90s. Companies put heavy portfolios in the junk bond market, and the junk bond market collapsed. And I know the gentleman sitting next to me, Mr. Gallagher, El Presidente, as you call him, was actually on a receivership team. Now, he can also take credit for the fact that that company was salvaged and brought back to a viable company, operating and actually paying dividends. But it was a life insurance company. But they had a heavy market investment in an area, and the market turned upside down, just like it did in 2008. And they didn't have the capital and the surplus to maintain, and they went into receivership, but they were salvaged by the Pennsylvania Insurance Department. So investments, the investment managers of an insurance company have to be able to, one, have liquidity, have a good earning, and it has to be a sound investment, or else it can be very risky. If the income investments go down and premium goes down and claims go up, that company may be having a little bit of a problem. Now, a lot of that is management, and that's another thing you will find that in profitability section of this, poor management will never survive. You can have some bad years on premium, you can have some bad years on claims, you can have a 3-digit combined ratio, but if you have good management, sometimes you can steer clear of disaster. But if you have poor management and poor claims experience, poor underwriting experience, and a loss of premium revenue, you're probably going to find that company going to liquidation. And that is one of the primary reasons companies do go to liquidation, is poor management. But as far as revenue, keep in mind the two primary areas are investment and premium, with premium usually the more visible one to the public. On expenses, you'll see in the course that they broke it down somewhat differently. I always just looked at it, and most folks just look at it. You have the expenses are your claims paid, claims reserve set, your either underwriting loss or gain, hopefully not a loss, taxes, your commissions that you pay, your marketing folks, and everything else you pay, from technology to postage to paper, your other expenses, workers' comp for your employees, health benefits, all of those are the expenses. They're just wrapped into one big ball. I always included taxes in there, but I noticed in the thing that they broke income taxes out separate, but that's an expense. And at the end of the day, you take, on the one side, you take the investment income and the premium income, and on the other side, you take all the expenses, and hopefully on the left side of that formula, there's a plus, and that means the company made a profit. And in most cases, if a company can keep its operating expenses, excuse me, to where claims are 68 to 72 cents on every premium dollar, maintain their other operational expenses, and then they will make a profit. Once they start getting their claims approaching the 80 cents on the dollar, they're probably going to look for a premium increase, because now they're getting close to where their other expenses are going to take them in the negative. And of course, once they get above 85, 90, they're getting into trouble. And so the ideal operational area for a company is 68 to 72 cents on the dollar of premiums paid out in claims. And then they will make money.
Jack,
Yep.
I did get a question here. It said you used the term profit. As a mutual, we don't have profits. So how is that classified?
Well, you're looking at, when they look at the profit of a company, they're looking at the assets of the company equal the liability plus the owner's equity. In a mutual insurance company, policyholders are the owner's equity, and the owner's equity is usually the fancy name for policyholder surplus or the surplus. So at the end of the day, if a mutual has a surplus, they're going to pay a dividend to the owners, which are the policyholders.
Thank you.
Yep. Okay. We are in revenue and expenses. So we've already gone over the net underwriting gain or loss, and that takes all of your underwriting expenses that I explained before, all the data that the underwriter's bringing in. When you, if you're writing personal auto and you're going down to PennDOT to get a driver's history, you're paying for that history. If you're accessing credit reports, you're paying for that. All of those expenses plus the salary of the underwriter come into play. And at the end of the day, hopefully your underwriters are doing a bang-up job, and they're issuing policies on good risks where you're keeping the claims down below the 70 cents on the dollar for the premium coming in. And underwriters, have many tools in their box, and if they use them correctly, most of them remain very profitable. The overall gain is a different type of calculation on a formula, and what it does is it looks at combined ratios, the loss ratios. It's a little more complex. It does give a little better objective view of the financial status of an insurance company, but it's probably a little bit more than most people. I mean, Steve Johnson would take a hard look at that. Like Ron said, he was the deputy for the corporate reg area. His folks would be more inclined to look at operational expenses of a company on the financial reports. Over in the rate and form area where they're asking for premium increases, they're going to be looking at combined ratios and things of that nature. But for most cases, everybody looks at the underwriting. It's a little easier to look at. We took in X number of premiums. We paid out Y. X was higher than Y. We had a profit, an underwriting profit. The other one takes into other types of formulas, including the investment income and the expenses related to that. It's a little more complex, but it does give a better view of the profitability of an insurance company. So, move on to the insurers. Admitted, admitted, residual, and government. Okay, and really, and that is the actual correct term. Insurance companies really are not licensed in a jurisdiction. They are admitted to that jurisdiction. And if they're admitted, then they're in what we term the admitted market or voluntary market. You can buy insurance from them. You have the non-admitted market, and in the non-admitted market is mostly what people just refer to as surplus lines. It's a heavy market in Pennsylvania. There is a lot of business there. It's regulated differently. In the admitted market, an insurance company brings in its premiums. It calculates its premium tax and pays tax to the Department of Revenue. In the non-admitted market, the insurance company is not admitted to Pennsylvania, and the producer is held to that standard. So they calculate the premium, assess the premium to the insured separately, and remit the premium tax to the Department of Revenue. So it works a little bit differently, but the end result is the same. There's a policy of insurance out there. Now, the admitted market in Pennsylvania is definitely larger. When I left the department in June, when I retired, roughly 1,700 companies in the admitted market. They're writing somewhere in the admitted market, somewhere between 86 and 90 billion dollars in premium. The other premium that Ron reflected was coming from the other markets, the residual market, the non-admitted market, and government programs. The residual market, the best way to think of that is the FAIR Plan or the assigned insurance plan. The market of last resort, a lot of folks call it. The fair access to insurance rates is the FAIR Plan. It's actually an insurance company. It's the insurance placement facility, and they issue property and coverage. The assigned insurance plan, AIP, or Roberts Plan, as it's sometimes referred to, is the assigned insurance market for auto to meet the requirements of the MVFRL. And those are actual insurance markets. They're not government programs. When you look at the government program, the two most prevalent government programs out there, the National Flood Insurance Program and the Terrorism Risk Insurance Act. And it's unique in these. In the NFIP program, National Flood Program, the government actually acts as the insurer. But in TRIA, the terror risk, they actually act as a reinsurer. So in this government market, the federal government plays two distinct roles differently in keeping the market viable. Now, a lot of folks look at the NFIP. There's nothing in the Pennsylvania insurance laws that prohibit a property company from covering flood on a homeowner's policy. Nothing at all. The reason they don't is because of the catastrophic loss that occurs in a flood. And it's something that they can't really determine for premium, the risk of loss. It's easier to do it as a separate standalone contract out there. And there are companies that operate under the NFIP and called Write Your Own, and they do issue it. But on the typical homeowners policy, it's a little bit tough to try to assess that premium for that loss. So that is the reason that the companies choose not to do it. If you look at a standard homeowners 3 policy, the most common form out there, or some variant of the HO3 policy, this what is called either the all risk or special risk, Section 3 or Section C, depending on how the company logos it, will list a number of exclusions to the policy of what is not covered. And one of the things that I found when I was doing some compliance work in the industry was there's an HO2 policy format and an HO3. And an HO2 is a broad form. It has different standards when a claim is presented than does the HO3. But many agents, in trying to differentiate it for the customer who is not schooled in insurance, will say, well, this is an all risk policy, it covers everything. Where the broad form doesn't. It's named peril. A broad form homeowners policy is named peril. If the loss occurs by a peril that is actually named in the policy, it's covered. If it doesn't, it's not. On the HO3, they call it all perils except for those excluded in Section 3. The problem that we always had in the compliance area was they forgot that portion of the sentence. So they always told the person, covers everything. All risks are covered. And that creates a problem because then when the person has a loss, when there's a mudslide and it cracks their foundation, they find out that earth movement's not covered. So agents sometimes create their own headaches for themselves by not being a little more explicit in their explanations. But those are the 3 types of typical insurers that operate in almost every given market across the country. And even in the territories, there are 56 members of the NAIC, which we'll touch on later. But almost every state has the government programs, the residual markets, and the admitted and non-admitted market, and they're very viable in almost every state. And then going from those markets to markets in competition. The number and size of competing insurers, and Pennsylvania is very diverse. In Western Pennsylvania is a domestic company, which is one of the largest property and casualty insurers in the world, if not the largest, National Union Fire, NUFIC. It is one of the members of the AIG group. And then we have some other companies located throughout the state that may or may not even have a 7-figure surplus. So the market in Pennsylvania is extremely diverse, from the largest insurance company in the world to some of the smallest in the country. They compete on a level playing field in Pennsylvania. That's the driving in the laws of the Commonwealth. We have our Unfair Insurance Practices Act. We have our the Producer Act, which is Act 147. And all of these sections tie together that you can't advantage yourself through improper competition. You can't induce people to buy your insurance, and you can't give them rebates for buying. And the reason for those 2 laws on the book are to keep the playing field level between the largest carriers and the super large and the national carriers that play here, and the regional or domestic only carriers that play here. And it would be very easy for a company like National Union Fire, if they wanted to induce people to buy, they could give away a Mercedes, and other companies wouldn't be able to give away calendars. So by having very uniform laws on the books and enforcing those laws uniformly, we keep the level playing field open to the market, and that benefits consumers. That they can't be enticed to buy a product from one company simply because of the financial strength and size of that company. They can buy that product from that company because they want to buy that product. They may have a better premium than another company if they've had better loss controls, but that doesn't necessarily mean that everybody drives to the lowest premium. Some people will stay with a company even though they could save a little bit of money simply because they like the service, okay? And that is their choice. But the market has grown in Pennsylvania. We've held steady at around the 1,700 companies for at least the past 15 years, but the premium has gone up substantially. When I first joined the department in 1994, if I recall, it was somewhere around the mid-50, like 55, 56 billion. And today we're hitting in the $90 billion area. So it has almost doubled in 20 years. And that's a good premium increase with the typical market incline. But those are things that you definitely want to keep in mind, that the reason that the laws are on the books the way they're on the books is to keep that playing field extremely level. And that's a great segue into the reasons for insurance regulation. Okay. They say that the primary reason an insurance department or commission, whichever they are easily known as, most of them are insurance departments, existed for the protection of consumers. I take a little bit different look at it. I say that's the end result of what we do. When you look at what an insurance department does, it operates in two distinct avenues. The easiest way to explain it is there's front-end regulation and back-end regulation. Okay, and in front-end regulation, Mr. Johnson is tops. You have the admission of companies to do business. You have policy rate and form approval. So companies are trying to get their products approved. They're trying to get admitted. And then those are all front-end activities. Then you have the market reg activity. That's where you actually monitor what the company's doing. That's all back-end. And a lot of folks don't quite understand that in some areas. The bureau I headed, licensing and enforcement, actually was one of the few areas that did both front and back end regulation. On the licensing side, where we were licensing people to get into business, that's front end reg. We're screening these folks and making sure that they are worthy to deal with the public in the trustworthy nature. On the enforcement side, it was all reactive to violations of law. The insurance department does not go out and check to see if you're breaking the law. We react like any other police force. We suspect the law has been broken, or we have information that the law has been broken, and we conduct an investigation in one manner or another. In my area, they were called field investigations because we actually went out and conducted on-site interviews with people and respondents. In the area of market conduct, it's an examination of the company on-site at the company. The examiners do not deal with the agents. They do not deal with the consumers. They deal solely with the company. So it works a little bit differently, but it's still responding to something that triggered a review of what business was being transpired and was it done in accordance with the law. Sure, on the front end side, they maintain insurer solvency. That's a given. You want to keep the insurers solvent so that they can pay the claims as they arise. You want to prevent destructive competition. You do not want one company trying to trounce on another company. Making denigrating remarks violates the advertising statutes of the insurance laws. You can say whatever's true, but you can't go out and make denigrating remarks. Okay, so if if someone says that a company is not paying its claims and they have orders issued by the department because of enforcement actions that, hey, they didn't pay these claims, that's true. In that sense, they did not pay those claims. It doesn't mean that they're not paying all claims. So you have to be careful when one insurer is trying to slight another one. But that we do control. You have premium rate and review. So you have folks upstairs, actuaries, that are looking at rate filings to make sure that the premiums that the people will pay meet one of three tests, and this is what premiums cannot be. We don't say what premiums should be. What the insurance laws say, the premiums cannot be excessive, inadequate, or discriminatory. Okay? Other than that, they are deemed to be fair. You can't charge one person a premium and charge a similarly situated individual a higher premium. That's discriminatory. Okay, just because they may be a different creed, color, race, whatever, they're to be uniform. You can charge a person a higher auto premium that has accidents than a person that doesn't have any. That's underwriting and that's rate filing. So premiums cannot be excessive, inadequate, or discriminatory. What the insurance department does by making sure that the premiums are fair, that the insurers are solvent, that the marketing is conducted in accordance with the law, is ultimately done for the protection of consumers. And that's why I said at the beginning, what we do, the end result is consumer protection. We're not out there in the front line trying to protect the consumer. We're performing all our other regulatory functions in the sense of protecting the consumer. And I told a former commissioner and my former boss who's sitting here that my job at the insurance department was not to protect the consumer from themselves. My job was to protect them from abuse in the market. So if a consumer makes a poor choice on a product, and they had all of the information to make an informed choice, and they just made a poor choice, that does not give rise that they were treated unfairly, that the agent did something or the company did something, or if the claim was denied because they bought a wrong type of policy. Even though they had all the information and they chose policy B over A, A would have covered it, B didn't, that doesn't make the insurer or the agent responsible for the poor choice. But if information was concealed from that consumer that led them to make that choice, then it's an issue that the insurance department has to deal with, because that person wasn't given adequate information, was given poor information, in some manner, wasn't afforded sufficient documentation to make an informed choice. And that's when the regulatory arm of the department has to act. So with that, we'll move on to what the insurance department is actually comprised of. And most of them are in the same manner. Insurance under what it's called insurance regulator section. Most departments are comprised of a commissioner. New York is headed by a superintendent. Some other states are headed by a director, depending on how the department is structured. But the cabinet level, the senior member, we call him a commissioner in Pennsylvania, in Pennsylvania is an agency of the executive branch. All of the departments are, because they enforce the law. There's three branches, brief history, three branches of government established in the country: legislative, judicial, executive. Legislative, enact laws; judicial, interpret laws; and executive, enforce the laws. So since the insurance departments are enforcing the insurance laws in that particular jurisdiction, they're in the executive branch. The Pennsylvania Insurance Department is, like I said, headed by a commissioner, and presently it's Teresa Miller, and Commissioner Miller. The department is broken up into offices. Each office is headed by a deputy commissioner. In Pennsylvania, there's corporate reg, product reg, market reg, are the three that deal with the everyday business activities of both the department and the insurance companies that are operating here. The department then, each office is broken down into bureaus, and those bureaus perform specific functions, and those bureaus may be broken into divisions, but they're all headed by, at the bureau level, they're headed by a director, and below that, depending on the title the people wear, they're managers, supervisors, chiefs, whatever. Those operate the day-to-day. The commissioner operates at a executive management level as a member of the staff of the governor. She depends on the deputies The deputies, of course, depend on the directors, and the directors depend on their managers and for the day-to-day operation. And almost every insurance department across the country is made up of that manner. Some insurance commissioners are elected. Delaware elects the insurance commissioner. Pennsylvania, the commissioner is appointed by the governor. There's pros and cons to both. In some cases, there's no political agenda for an appointed commissioner because they don't campaign. On the other hand, they work at the will of the governor, and they can be let go, whatever, at any point in time. Where an elected official is usually in office unless they resign or die. They're in office for their term. I met the commissioners of other states, and I never found where there was really a bright line of one is better than the other. Each state, Delaware, my good friend down there, Gene Reed, was my counterpart down there. He's a deputy. He doesn't do his job any differently than I did mine, even though he works for an elected commissioner and I work for an appointed one. There are 56 members of the National Association of Insurance Commissioners. There's the 50 states, Washington, D.C., and the 5 territories, Virgin Islands, Guam, Puerto Rico, Northern Mariana Islands, and American Samoa. Those are the members of the NAIC. And let's keep in mind that the NAIC is not a regulatory agency. It is an association. It is a forum where industry, consumer advocates, and insurance departments can come together and try to create best practices approach to regulation, best practices approach to laws, and one example is the Producer Licensing Model Act, a totally revitalized and revised licensing of individuals to sell, solicit, and negotiate. In Pennsylvania, we did away with the agent and broker law. We have insurance producers. They only need one license to perform the duties. Excuse me. But every state has adopted it to some degree. Also makes the laws very uniform. So if you're breaking a law in Tennessee or Texas, you're probably violating the same law in Pennsylvania if you're licensed here and doing the same business practice. The accreditation program under the NAIC allows for Steve Johnson to only have to do financial exams on his domestic companies instead of all 1,700 companies operating here to assure that they are financially stable. And then by accreditation, the companies that are domiciled in foreign jurisdictions, those jurisdictions guarantee Pennsylvania that those companies are viably solvent. So that's the accreditation program. It's very simple. 49 states are accredited. New York is not. New York, in order to do business in New York, you must be domiciled in New York. It is a holdover from laws dating back before the 20th century. So if an insurance company wishes to operate in New York, it has to domicile there or create a subsidiary domiciled company in New York. One that comes to mind for me is Erie Insurance Company. Domiciled Pennsylvania, in Erie, Pennsylvania. They also have Erie Insurance of New York. They're domiciled in New York to do business there. So New York's not accredited, but it's the only other state that isn't. But then the companies that are doing business there are examined by New York. So even if they're domiciled there and doing business here, New York is still verifying that they are financially solvent. The other drive of the NAIC, like I said, and I spoke about the Model Act, Producer Model Act, is to drive model laws. And model laws, once they're agreed upon, and they're written in a format that each state has to take and then put it in its own state. In what I would call, once we bring a model law to Pennsylvania, we have to Pennsylvaniaize it. Our laws our acts are structured differently than that of Michigan or Montana or California. So we have to put it in our format, but we have the driving basis of the document. It was created in a concerted effort by the whatever committee at the NAIC, voted on by the commissioners and adopted, and then it comes back as a model law. They also have model acts, and if we were bringing a model act back to Pennsylvania, it would probably drive to a regulation before it would drive to a statute. And when we do refer to Pennsylvania laws, we really don't have laws in Pennsylvania. What we have are statutes and regulations. The statute is what would be the governing primary document, or what we would call the law. The regulation then pulls out and defines certain areas of that law in more detail. So if you look at the Producer Model Act, we really don't have, the regulations didn't have to be rewritten. The way we crafted the law, we repealed the regulations that were inconsistent, but the regulations that we would have basically brought back again, we left stand. So that is why there hasn't been new regulations done for the Producer Licensing Model Act. Many laws require regulations immediately, and if you look in it, it will tell you that the department has authority to promulgate regulations. But that's how the NAIC works. It acts as a venue where the industry, the regulators, and consumer groups can come together and try to form a best practice. And then there's the federal regulators. Now, in the property and casualty market, other than the NFIP and TRIA, you really don't have a lot of federal regulation. However, in the life market, in the annuity market, the Financial Industry Regulatory Authority, abbreviated FINRA, operates where the NASD and the New York Stock Exchange used to operate, and controls what we would call the registered market. But there is federal regulation in other areas. And one thing that insurance companies face is they are duly regulated but not in the business of insurance. It dates back to the 40s. In 1945, there was a Supreme Court decision, United States Supreme Court decision, that held that insurance is interstate commerce. And as interstate commerce is thus subject to the federal regulatory agencies and not the states. But it also held out that it defined the business of insurance. And the business of insurance at the time by the Supreme Court, SCOTUS called it, there was a three-prong test. There had to be a risk of loss by a person. The person then had to transfer that risk of loss to a third party. And for that transfer, there was a consideration. It didn't say money was exchanged. It said there was a consideration. Then realizing that this can hamper things because the way companies were underwriting and issuing policies in Louisiana along the Gulf Coast is far different than the way they were doing it in Pennsylvania or Maine. There's not too many homes in Pennsylvania that are going to face a hurricane and have their roof blown off, but maybe in January or February they may have some snow and ice on it and will collapse. So your risks were different. And Congressman McCarran and Congressman Ferguson realized that and drafted what became known as the McCarran-Ferguson Act. And what McCarran-Ferguson did, and it's referenced in your study materials as only as McCarran, but what McCarran-Ferguson did was acknowledge SCOTUS's ruling that it is interstate commerce. But for the business of insurance, as defined, the states would remain in control and would regulate the business of insurance. But other areas, since it was interstate commerce, would fall to the federal agencies. And where that would be is labor. Okay, insurance companies have to buy workers' comp. They have to comply with OSHA requirements. They have to pay federal income tax. They have to operate as any other business would operate under the interstate commerce rules. The only portion of their business that is state regulated is defined by SCOTUS as the business of insurance. And so insurance companies are duly regulated. So there is a federal regulator on on an insurance company, but they do not always control the business of insurance. In many cases, that's only for labor standards, other employment standards, ERISA standards when they're issuing their benefits, health benefits. They have to comply with ERISA requirements and the pension requirements, and now the ACA. So with that, we can move on to insurance regulatory activities and how we monitor the insurers. And since I'm now retired, I can tell you, because I always used to tell Ron, I can't tell you what I'm doing. In fact, one former commissioner, when he came on board, he wanted to have a meeting of the executive and senior staff. And, of course, executive staff were the deputies, like Ron and Steve Johnson. And the directors, like myself, we were senior staff. And there was about 12 people in there, and I come drifting through the door, and I saw the commissioner, and he was standing there, and he said, oh, he knew me. And in fact, I had just had a case that he was representing an individual on about 5 months before that. And he shook my hand. He said, I know Jack, and I know what he does, but I don't know what he's doing, and we're going to have to keep it that way. And that was probably the easiest way to explain the market activities of an insurance department. Whether now it's run by a young man named Chris Monahan. He's the deputy commissioner for the market reg area, Office of Market Regulation. It is critical that the commissioner, in this case Teresa Miller, and Chris Monahan both know what their respective bureaus are doing, the Bureau of Market Conduct and the Bureau of Licensing and Enforcement. They know what they're doing, but they cannot know what exactly they're doing. They are not to be compromised in their ability to make a ruling by having basically inside information of investigations and examinations on carriers. At the end of the day, they have to determine whether the bureau director, that bureau director's decision is appropriate under the law and meets the standards of the law. Therefore, they can't know exactly what we do. And so through the regulatory activities of monitoring, we use different ways to arrive at that. Naturally, I'm sure everyone knows that there's a Bureau of Consumer Services, and its director is presently Carolyn Morris. And I actually worked for Carolyn for 5 years, almost 6 years, before Ron hornswoggled me into becoming a bureau director. But Carolyn runs the Bureau of Consumer Services. Any consumer can send a complaint into the Bureau of Consumer Services, and some of them are just simply, I can't locate my company, I can't find my policy. But many times it's my company's terminating my policy, didn't pay my claim, whatever. Carolyn's folks investigate the complaint, basically via communications between the consumer and the company or the agent, whichever licensee is the consumer is complaining about, or both. I mean, they may need statements from the agent and the company, and determine if the law was violated. And then they use a complex system of codings that can trigger additional enforcement actions of the department. If it's an insurance company, Carolyn has discretion as to whether she wants to code it for a suspected violation and refer it for market conduct review, or she wants to suspect the violation and refer it for field investigations review. Then on the field side, it will come directly over and it will be reviewed there. On the other side, where she's referring it for market conduct, there is another area under the Bureau of Market Conduct that does analysis of these complaints. They extract data from the National Association of Insurance Commissioner databases. And what they do is they look at the trend of this company. So if a company has 10% of the market in Pennsylvania, we would expect them to have 10% of the complaints. We would expect the ratio to be similar. If it's lower, good. But if it's higher, how much higher? So if a company has 10% of the market but has 50% of the complaints coming in, that triggers that something's not right there. What's the basis for the complaints? It's claim delays. So they're people are not satisfied with the amount of money they're receiving, and there a lot of times they're delaying the claims. What a lot of folks don't realize is that when investigators like myself, when we're analyzing that data, we're looking at that saying there could be a financial solvency problem here. Companies don't habitually delay claims and underpay claims because they know, one, it's going to attract the regulator unless they're having money problems. So if they're having financial problems, then that's a trigger to us. And maybe we, excuse me, not only need to take a look at market conduct, but we need to alert Mr. Johnson's folks up there to start taking a look at some numbers. One of the ways they look at those solvency numbers, other than through the complaint data and the investigation data, is what they call risk-based capital. And so these are formulas that they use. So when this number is at 300, well, that's pretty good, 300. 400 is real good. But when you see an RBC number and it's down like 120, that's sending a message that the company is having some financial difficulties. All of these tools go together. So there's what I'm trying to explain is the insurance department works quietly as a team. There's no one area of the department that is more important than another area because everybody relies on the other area for the information to make a correct decision. Just like the insurance consumer relies on being given adequate information to make an informed choice. Unfortunately, not all insurers remain solvent. Some of them will go to liquidation, and that is a whole other area for the department. It's separate from the department, the Bureau of Liquidations. It also is headed by a deputy. And in the cases of those liquidations and insolvencies, there are guarantee funds that the insurance companies pay into based on their premiums that guarantee not all of the claimed money. I mean, in some cases, someone may get 100%, but in other cases, they may not get it all of an insolvency, and we try to resurrect it. And of course, one of the other goals of the department's Bureau of Liquidations would be to try to get the business bought by an insurance company, in the same market. So if they could get them to take on a book of business, basically, and keep it from going to the guarantee fund and people losing their coverage. So a lot of that goes on there. But the reasons for insolvency, like I pointed out earlier, one of the primary reasons for an insurer company insolvency would be poor management. Another would be poor investments, and then poor underwriting. Those three combined will create enough problems to send an insurer south. Poor management being the first, because they can recover from the poor investments. You can get an upswing, you can change your investment portfolio, you can change your direction, so you can recover from that. You can tighten up your underwriting guidelines. You can go to 0-0 underwriting, which if any of you are underwriters, you hopefully know what that is. If you're not, 0-0 underwriting means that there's no losses, nothing in the background. The person is squeaky clean and one step from sainthood. Then you issue. So 0-0 underwriting is very tough. But sometimes when you're having underwriting losses, you have to tighten up the underwriting. And all of those can work together to bring an insurer out. But if they're still being driven by poor managers making really poor choices, even the best underwriters are going to have a hard time to keep and best investment managers will have a hard time to keep the company afloat. But those are some of the ways that even enforcement assists in solvency monitoring. There's a reason why something's happening, and it's being brought to our attention, and we analyze it. So the thing you have to remember is just because someone says the law has been violated doesn't mean that one particular enforcement area of the department kicks in and starts working. There was a lot of times that information came to my desk, and I would review it for 2 or 3 months, watching additional information before I would make a decision on how I wanted my bureau to proceed. And if I felt that the issue was better served in another area, I would get with the bureau director. Normally, it would have been Carolyn Moore sending me something, or one of the folks upstairs, Mr. Johnson, sent some stuff down to me. I would go back to my deputy and brief him, and then say, I think it's better handled like this because of this reason. And then everybody gets together on it. And of course, there's a lot of study that goes on in regulatory activities, monitoring solvency. It's just not the financial arm of the department. Consumer services is involved, enforcement's involved, everyone is involved. So now we'll down to the more regulatory activities of market conduct and consumer protection. The market conduct, basically in Pennsylvania, comes in two forms. Market conduct exam of an insurance company, any licensee, whether it's an insurance company or an insurance agent or public adjuster. It's done through the driver is usually a consumer complaint. That index gets upset. Like I said, if you get 10% of the business, you get 10% of the complaints, you're going to draw some scrutiny, but you're not going to trigger something that's going to rise up. But if you have 10% of the market and 50% of the complaints, I can pretty much assure you that the two bureau directors that are involved in enforcement, Bureau of Market Conduct and Bureau of Enforcement, will be looking at.
We're just aware that the internet may have gone down for a second, so we're going to check out to see what's going on. But Jack can continue with the audio portion.
Okay. Well, if you can see it, what we're talking about now is practice between practices and practices. And this is all monitored by market conduct activity. And it's a broad brush. Typically, all of those practices will be determined sometimes through consumer complaints. My coverage, my claim wasn't paid, it was underpaid, my insurance was scanty, my agent. So something came to the attention of the department. We check the data, take a look at it, and then they will set up. If it's a market conduct issue with market conduct, Bureau of Market Conduct is going to send examiners on site. They will send a letter out to the company, tell them what they're going to look at.